Kia ora. I'm just going to put together a quick tutorial on how to work out provisional tax using the ratio method. Okay, so just a quick recap on provisional tax anyway, just to sort of set the scene. So provisional tax is paid in the year you're trading as you go, and it's to and at the end of the year when you file your tax return, you work out what the actual tax due is, and if the actual tax due is less than the provisional tax you've paid, you'll get a refund. If the actual tax that you owe is more than the provisional tax that you've paid, you'll need to pay some terminal tax, right? So it is a pay-as-you-go method. E.g., when you see the payment dates, they're actually during the year you're actually trading in. So really, you should have, I suppose, if you've put the money aside from the profits, it should be there when you need it. All right. So the four methods: the standard method, which is by far the most common; the estimation method, again, but that can be utilised with the standard method. So the standard method, and I'll explain these in more detail in a second. The ratio method, which is the one I'm going to try and explain to you in this tutorial in a little bit more detail. And then there's the accounting income method, which will tell you what it is, but you're not tested on it in this paper. Okay. So first of all, the standard method. I've written some notes here already. So just what does that mean? It's last year's residual income tax times 1.05. So it's last year's residual tax uplifted 5%. Okay, you'll need to understand what residual income tax is, and I'll cover that off in this tutorial as well. You may already know, but I will cover it off. Okay, so you work that out. You divide that by 3. And therefore you make those payments on the particular dates, right? So if this is you've finalised your tax return for the 2020 year, you know what those amounts are. You've got your residual income tax, you've uplifted it by 5%. By the time you get by that, divide by 3, you'd pay that amount on the 7th of August, that amount on the 15th of January, and the same amount on the 7th of May, all right? Okay. If for some reason you haven't filed your tax return by the 7th of August or January even, because that happens, not everybody gets their tax returns done straight away. It's spread out over the year, especially if you're using a tax agent who can't do them all before August, as they probably wouldn't have much to do after that. Not only that, yeah. So if that's the case, the residual method picks up the year before plus 10%. And once you file your tax return, there's an unders and overs, and you've either pay more on the next ones or a little bit less, depending on the result from the 2020 year. So it's an unders and overs thing. Once you file the return, it's automatically done. Okay. So the standard method is the most commonly used method, and you do have the ability to change the estimation method during the year if you feel you should. E.g., your business has a downturn, you feel like you're paying too much, you're scheduling to pay too much tax because you're only going to do half as good as last year, therefore you can estimate it, right? So that brings us on to the estimation method. You can do that from the get-go, or you can change to it during the year based on the fact that things have changed. All right, so it's just a matter of there's a standard thing you can do online, or there's a form where you can re-estimate your tax, and therefore the IRD is only expecting the re-estimated amount. Okay, there is a contingency there that you need to get it pretty much 80% right, otherwise you will be up for penalties and use of money interest. Okay, so estimation method, using those two together combined is the most common way people pay provisional tax. All right. They have brought in something called the ratio method, okay, right, which we're going to talk about today, and that is where they said, hey, there must be a way of, without estimating it, running by the GST returns, work out roughly what the GST is. So they came up with what they called the ratio method, and that's based on your previous result. So to go to the ratio method, you need to have at least a bit over a year of trading and you've filed a tax return, so that you've got some history there, because the ratio is provided by the Inland Revenue. They'll look at what you've filed and they'll say, right, so based on your residual income, you had this amount of sales, GST inclusive. So that is this sort of percentage. So they'll give you a percentage, and there's a second page to a GST return, and it's a GST return 101B, where there's a second page where you calculate, using the ratio given to you by the Inland Revenue, of that percentage times the sales in the 2-month period. Okay, and that will give you what provisional tax you should pay and you pay that at the same time as you pay your GST. All right, so e.g. if they give you a ratio of 5% and your sales was $100,000, your provisional tax would be $5,000 for that period. Okay, we're going to have a look at some returns quickly to go over that. All right, just to be complete, the accounting income method really is, again, it's when you do your GST returns, but rather than using a ratio, you do the various accruals that you would do normally in a year in a set of accounts. And yeah, so again, it's another way of sort of trying to be a bit more accurate about the tax figure, right? Again, the uptake on the accounting method, similar to the ratio method, not very high, okay? I mean, I've been doing accounts for a long time, and to tell the truth, just about 99%, if not all, people that I deal with use the standard method and the estimation method, right? Okay, and I notice, for example, the ratio method, if you look on Xero, it asks you how you're filing your GST, and it really only gives you really sort of those options about on the payments basis or the invoice basis. I haven't seen where you can actually do the ratio method on Xero. Hey, it could be there. I just haven't come across it, right? Because I haven't really been looking for it. Most people I deal with use the standard method, and then we utilize the estimation method if required, right? It's probably no different than trying to use these two, right? Okay, so the ratio method, I've set up some things on provisional tax ratio method, paying provisional tax with GST. Okay, so I've, due to the request, I'll put some stuff here. This is where this video clip will be. Okay, so the first thing, let's have a look at one of these returns. Okay, I've quickly filled one in. Excuse the writing. So that would be the first page of the GST return. Okay, it's actually a 103B. I'm not too sure why I said 101, but anyway, I'll check that out in a second. All right, okay, so pretty much a straightforward GST return on the front. So you work out that how much GST you would have to owe, right? On the second page, you come into the tax part, right? So what is your sales? So if it's $100,000, box 5. Okay, if you're filing monthly GST returns, okay, you put the other figure there too. So you're getting a 2 months worth of revenue, gives you that figure there. Okay. You've got the ability to add, if you're doing the GST return for a branch, their sales in here, okay? All right. Come down here, there's an adjustment, right? So if you've sold a fixed asset, you don't want to be that, because the fixed asset's not going to really affect your net profit. It might, due to depreciation recovered or loss on sale, but in reality, it's not a clear sale. So you need to deduct off anything that isn't sales, like the sale of a truck or whatever, plant equipment, a building or whatever. So you're just coming down to your trading revenue. Okay, then you apply that percentage they've given you, and that gives you the provisional tax to pay. Right, so there's your provisional tax. Okay, if you're going to get a GST refund, you could offset that against it. So the GST refund would reduce the amount that you're going to need to pay. In this case, it's not a refund, so we just bring that 5,000 down. Bring over the GST, what we had to pay them, add the two together, and that's how much we're going to pay them. All right, so this is the ratio method, and you pay that once you file your GST return. Okay, so that's that. There's a GST guide, the pages 15 to 19. So the IRD on their website, you should find their guidebook. All right, so that's the link to it. I notice if I download these books and then upload them into Moodle, for some reason it must be encrypted somehow, okay, because it goes all funny on me, wingdings, okay. But if you go to, I'll give you the page references, the ratio option, okay. I've gone over these just to give you a high level of these things, right. There are thresholds and who can do it and who can't do it, and you know, those sorts of things, okay. So qualifying for the ratio option, all right, there's the various things, okay. Bear in mind your residual income tax ROT for the previous year is greater than 2.5. That's for the 2021 year, that's increasing to 5,000, right? So it used to be if your residual income tax is less than or was greater than $2,500, you'd pay provisional tax. If your RIT is now has to be over 5,000, so if you don't pay provisional tax because your residual income tax is less than 5, you haven't paid any provisional tax. So when you do your tax return, it'll be you'll typically have a terminal tax bill to pay, but it'll typically be under $5,000 now, and it used to be typically under 2.5. So that's something they've increased, right? Okay, so this is a good guidebook. I've given you the references in here for the ratio, but there's also all of the other methods as well, right? So the IRD booklets are always good reference material, okay? So that's the book I've given you there, a guidance on provisional tax ratio method. Okay, so that's just another link to the Inland Revenue website, more information on it. Okay, ceasing there, who can, okay, so that's just sort of web-based rather than in their booklet. Here we have it, what I just mentioned, your resident residual income tax for the previous year or later is greater than that. Okay, 5. Okay, so I think now is quite timely to quickly look at what residual income tax is. You might have a handle on it already, but that's good. If you don't, here's a quick example, right? So this is an extract from a company's tax return. So it's worked out all its income, any tax credits it's received, either on interest it's earned, or imputation credits on dividends, and withholding tax on dividends. If they've got any overseas income, they might have some foreign income tax paid, which they can put in the return as well. Okay, so I've kept this very simplistic just so we can get our head around what residual income tax is. Okay, and that's down here. I've underlined it, and that's what we're trying to aim to find out what our residual income tax is. Okay, so we work out our tax. So if we made $100,000 in profit, tax for the company is 28%. That's $28,000. Okay, overseas tax paid, I've said 0. Okay, simple calculation, so that still leaves us with $28,000. The next thing down here is sort of other credits here, okay, which would be in boxes 29C. Okay, so that again is foreign investment tax credit. I've got 0 there. Okay, just bring the number down. Okay, so on the previous worksheets you would know if you've got any of those credits. Okay, any imputation credits, I've assumed that they got no dividends. All right, so they got none of those as well. Brings it down to here. I've said that they've paid, they've received interest, and on that interest there was resident withholding tax deducted of $890. Okay, all right. RLWT, that's resident land withholding tax, so that's got to do with sales of land and things like that. Some withholding tax is deducted. That was to get around you know, one of these things where they're tightening up on property speculators. Okay, so none of that's paid. So really, the 28 less the withholding tax paid is 27,110. Okay, and that is your residual income tax. Okay, so where people have got mixed income, where they might have some income that has a lot of tax deducted or some tax deducted already, and then they have some income that doesn't have tax deducted, you're interested in knowing what the residual income tax is, because it means what would I normally pay in tax, how much has already been deducted somewhere else, so that gives me my residual income tax, in other words tax that I need to find. Okay, so this company's been paying provisional tax, and they paid $30,000 worth of provisional tax for the year. So if their residual income tax bill is 27,110, they've paid $30,000 in provisional, they're going to get a refund of what they've overpaid. Okay, and their calculation for next year will pick up the residual income tax, add 5%, and that will be their provisional tax they need to pay for the next year, right? So just get your head clear around the residual income tax. Okay, I've just gone through that pretty quickly. There's exercises and readings to drive that home a little bit further, and obviously you can contact me if you've got any questions. Right, I will save this and post this up on Moodle for you.